We're in a world now where there's such fear, there's so much of a sense of uncertainty that it is in the prices. It's not that we don't believe there's uncertainty, but more that it's discounted. And the dangerous time to invest is when people don't think there's any risk. That's when they get killed.
When it comes to investing, many people feel nervous about getting started. Maybe you felt that way too. Investing can seem really complicated and intimidating. How do you know you'll do it right? A big part of the problem is all the myths surrounding investing. These myths can make the whole process seem much scarier and more difficult than it actually is. And in this video, we're going to bust 7 common investing myths that might be holding you back. You need to unlearn these to skyrocket your returns. By the end of this video, you'll have the truth that can help you get started on your investing journey with confidence. Whether you think you need a lot of money to start, believe that investing is just like gambling, or worry that the stock market is too risky, we've got the real answers for you. Now, before we get started, if you're new to our channel, don't forget to subscribe and hit the bell icon so you won't miss out on the valuable insights we share in our future videos. All right now, let's unlearn these myths so you can skyrocket your returns. The first investing myth you need to unlearn is the idea that you need a lot of money. This couldn't be further from the truth. Nowadays, many brokers have apps and programs that let you start investing with very little money. You can even invest with pocket change. For example, websites like Betterment allow you to commit as little as $100 per month. If that still sounds like too much, apps like Acorns let you invest even smaller amounts. With Acorns, you can even round up your everyday purchases to the nearest dollar and invest the spare change. So if you buy a coffee for $2.75, Acorns will round it up to $3 and invest that extra 25 cents. So it doesn't matter how little you have available for investing. There's an app or a site out there that can help you get started. The key is to begin, no matter how small your initial investment. Once you start, you'll see how easy it is to build up your investment over time. Next, let's tackle another common myth that might be holding you back from investing. The second investing myth you need to unlearn is the idea that the stock market is too volatile. Now it's easy to feel nervous when the market drops 500 or 600 points in a single day. But even though the stock market has its ups and downs, the long-term trend usually smooths out and goes upward. So what you're gonna do is that rather than trying to time the market, focus on a long-term plan. Day-to-day volatility can be unsettling, but if you stick to your strategy and stay invested over the long haul, you can ride out the bumps. Historically, the stock market as a whole has not lost money over any 20-year period. That's why, instead of worrying about daily market fluctuations, think about your long-term goals. Consistent investing over time, even during market downturns, can help you build wealth. Remember, investing is a marathon, not a sprint. Moving forward, the next investing myth you need to unlearn is stocks are the only option for investing. It's easy to get caught up in the world of stocks because they are often the most talked about. However, there are many other types of investments that can provide you with a diversified portfolio. Bonds, for example, are a great way to add stability to your investments. They tend to be less volatile than stocks and can provide a steady stream of income. Real estate is another option that can offer both income and potential appreciation over time. You can invest directly by buying property or indirectly through real estate investment trusts, REITs. Commodities, such as gold and silver, are also worth considering. These can act as a hedge against inflation and provide some protection during economic downturns. Additionally, investing in currencies can be a way to diversify, though it's typically more complex and suitable for more experienced investors. So, if the stock market makes you a little nervous, it's okay to look into these other options. A well-diversified portfolio doesn't rely solely on one type of investment. Consider allocating up to 20% of your portfolio in other asset classes to provide a bit of diversity. This can help you manage risk and potentially improve your returns. Next myth is about you have to pick the right stock to succeed. Many potential investors worry about stock picking because there's so much emphasis on finding that one superstar stock. However, while choosing the right stock can be great for your portfolio, it's not a requirement for being a successful investor. Stock picking can be intimidating, especially if you're just starting out. The good news is, you don't have to rely on picking individual stocks to build a strong portfolio. Instead, consider investing in index funds or index exchange traded funds, ETFs. These types of investments take a broader approach by including a wide range of stocks within a particular index, such as the S&P 500. Investing in index funds or ETFs means you're relying on the overall market performance rather than putting all your hopes on a few individual stocks. This strategy can reduce your risk and provide more stable returns over time. It's a way to benefit from the general upward trend of the market without needing to become an expert in stock picking. Index funds and ETFs also offer the advantage of diversification. By investing in a broad selection of stocks, you spread out your risk. If one stock performs poorly, it won't have as significant an impact on your overall investment, because other stocks in the index may be doing well. Another common myth that might be preventing you from making the most of your investing journey is, it takes too much time to invest. Many people picture an investor as someone who spends hours poring over reports and adjusting stock screeners to find the perfect stock at the perfect time. This image can be pretty daunting and might make you feel like you don't have the time to invest. The good news is that investing doesn't have to be time-consuming. In fact, if you get involved with index investing, you might not need to spend much time at all finding the right fit. Broad-based index funds and ETFs don't require a lot of research because they cover a wide range of stocks within a particular index. This means you're investing in the overall market rather than individual stocks, saving you a lot of time and effort. Additionally, robo-advisors can help you build a portfolio based on your long-term goals and risk tolerance. These automated platforms use algorithms to create and manage your investments, so you don't have to spend hours researching and making decisions. Signing up with a robo-advisor often takes just a few minutes, and after that, your portfolio is managed for you. This allows you to focus on other aspects of your life while your investments grow. If you're worried about the time commitment, consider setting up automatic contributions to your investment accounts. This way, you're regularly investing without having to remember to do it manually. Over time, these small consistent investments can add up and help you build wealth without a significant time investment on your part. The next investing myth you need to unlearn is selling to avoid further losses. This is a common misconception that can lead to poor investment decisions. It might seem logical to sell your investments when the market is falling to avoid further losses. However, selling in a panic often leads to locking in those losses permanently. When the market is down, emotions can run high, and it's easy to become irrational. But remember, the market has historically recovered from downturns and continued to grow over time. Selling your investments during a market dip means you're selling low, which is the opposite of the classic investment advice: buy low, sell high. If you then buy back into the market during the recovery, you'll end up paying more and missing out on some of the gains. Instead of selling when the market is struggling, consider holding on to your investments. Better yet, it might be a good idea to buy more while prices are low. Think of it as a sale on investments. You can find solid bargains during market downturns, and buying at these lower prices can set you up for significant gains when the market recovers. For example, if a stock you believe in has dropped in price, purchasing more shares at a discount can increase your potential for higher returns when the stock price rebounds. This strategy, known as dollar cost averaging, involves regularly buying a fixed amount of an investment, regardless of its price. Over time, this can lower your average cost per share and help smooth out the effects of market volatility. Finally, the seventh myth that might be holding you back is, the professionals always beat the market. Many people believe that hiring a financial advisor or investing in a professionally managed fund guarantees better returns. While it's true that some professionals can beat the market some of the time, peer-reviewed studies have found that it's rare for an investment professional to consistently outperform the market. You might actually do better with a low-cost index fund. Index funds track a specific market index, such as the S&P 500, and aim to replicate its performance. Since these funds don't require active management, they typically have lower fees, which means more of your money stays invested and working for you. Over time, these savings on fees can significantly boost your overall returns. Besides, why do you need to beat the market anyway? The primary goal of investing should be to meet your long-term financial objectives, not to outdo the market or your friends. Investing is not a competition. It's about growing your wealth steadily and securely to reach your personal financial goals, whether that's saving for retirement, buying a home, or funding your child's education. Professionals can definitely help you set and achieve your financial goals. They can provide valuable advice, help you manage your money, and offer insights that you might not have on your own. However, it's important to have realistic expectations. Understand that they're not always going to beat the market, and you shouldn't expect them to. So, instead of focusing on beating the market, concentrate on building a diversified portfolio that aligns with your risk tolerance and financial goals. Regularly review and adjust your investments as needed, and stay committed to your long-term plan. This approach is more likely to lead to financial success than chasing the elusive goal of consistently outperforming the market. And these were the 7 common investing myths you need to unlearn to skyrocket your returns. With the right knowledge and strategies, anyone can start building wealth and achieving their financial goals. We hope you found this video helpful and that it gave you the confidence to get started or continue on your investing journey. If you enjoyed this content, please give us a thumbs up and share it with your friends and family who might also benefit from debunking these myths. And as usual, don't forget to subscribe to our channel and hit the bell icon so you won't miss out on our future videos. Thanks for watching, and we'll see you in the next video.